Dividend policy is a key financial decision where a company chooses whether to distribute profits to shareholders as dividends or to keep and reinvest those profits for future projects. The goal is to find a balance that maximizes future dividend payments and increases the company's market share price. When deciding whether to pay dividends, a company must consider several factors, including its cash availability and legal requirements that ensure capital maintenance through distributable reserves, meaning dividends typically cannot exceed the lower of these amounts. Other important considerations include the company's liquidity, as even profitable firms might not pay dividends if cash is tight, the investment opportunities available and their expected returns, the stability of earnings, with more consistent earnings allowing for a higher dividend payout, and the company's debt levels, since it might prioritize debt repayment over dividends. Control within the company can also play a role, as certain groups may prefer to retain earnings to maintain control rather than distribute dividends. Finally, tax implications for shareholders can influence the decision, especially in larger companies with many shareholders. All these factors help shape a balanced dividend policy that supports both shareholder value and the company's long-term growth. When a company is small and has only a few shareholders who pay income tax at higher rates, it might choose to pay lower dividend payouts. In these cases, the company usually retains more funds to invest in profitable opportunities, which can lead to growth in the share price. The company's growth plans also influence dividend policy. If significant capital investments are needed for future expansion, the company is less likely to distribute high dividends. Another key factor is the message the company wants to send to the stock market. Most companies aim to maintain stable dividends because steady dividend payments tend to support higher share prices. Shareholders often value stable dividends more because they see them as less risky and therefore apply a lower discount rate, which can increase the share price. On the other hand, if dividends are unpredictable, the investment is seen as riskier, which can lower the share price. With this understanding, we can now move on to the example in the illustration on dividend policy. The company's dividend policy is based on maintaining a payout ratio of 50% per year. Currently, the share price stands at £138.13, with a price-to-earnings ratio of 10.5, and there are 9.4 million shares issued. The company does not plan to issue more ordinary shares under current projections. To establish a stable dividend, the board looked at similar companies in the same industry and aimed for a dividend payment in the upper quartile of that group. They calculated the average dividend per share along with the standard deviation to measure variability, setting the target dividend at £6.59 per share in today's terms. This approach balances competitiveness with stability and takes into account maintaining capital in line with legal requirements. Dividends are typically limited by the company's cash available or its distributable reserves, whichever is lower. To calculate the payout, you multiply the number of ordinary shares by the dividend per share, then adjust for inflation as needed. In this case, the dividend per share remains stable with an annual inflation adjustment of 2.5%. With a price-to-earnings ratio of 10.5, this also implies a planned increase in share price, reflecting positive growth expectations. The company's strong cash position adds to its attractiveness. A well-designed dividend policy is key to balancing what shareholders expect with the company's need to grow over time. It builds trust by offering reliable returns, draws in long-term investors, and conveys financial health to the market. At the same time, it retains enough profit for reinvesting in the business, supporting ongoing growth and innovation. Ultimately, this approach helps maintain good relationships with shareholders while protecting the company's ability to adapt and create lasting value.